So we'll call the meeting of the Norwalk Pension Board to order. And first, maybe we could have approval for the minutes from October 11th. I had one comment. My name is misspelled. It's in for the approval and regarding the approval of the September 13 minutes. It's Henry Rickson. Other than that, any other comments?
No.
Motion to approve. Second, all in favor? Aye.
Right.
Okay. Are there any public comments? Anyone from the public joining? Any comments? No. Well, then we'll get right on to the one pension approval. Anyone want to share that?
Sure. So we have one pension approval request for this evening. Clarence Joseph, who was at the health department. He was a sanitarian. He was with the city of Norwalk for 23 years and 10 months. The commencement date would be July 29th of 2023. It's a regular pension and he selected the standard option.
Good to me.
It's good to me.
It starts back in July.
July.
Any discussions, questions?
It's fine from my
All in
perspective.
favor? Aye.
Aye.
Thank you.
So approved. We'll go to maybe the pension, performance review.
Sure. So I'll provide a little bit of a backdrop before diving into the September monthly performance. Markets were down in the third quarter. The expectation with markets has really hinted that they may believe rates may stay higher for longer than originally expected at the start of the year. I think the expectation is there potentially could be one interest rate hike left in 2023. Obviously, that remains to be seen. And most likely rates will not start to come down until sometime in 2024. That being said, the economy has largely been resilient. We've seen unemployment remain very tight. GDP growth in the second quarter was over 2%, and it's expected to grow even stronger in the third quarter. Over 3% is the current estimate. Inflation continues to slow down from its peaks in June of last year. Despite this, equity markets were down in the third quarter. The S&P 500 was down about 3.3%, still up about 13% year to date through September 30th. We did see small caps, in particular small cap value, significantly outperform growth during the third quarter, which is really a reversal of what we've seen. Growth stocks have been in favor for much of the last 10 years, and especially in the first two quarters of 2023. Non-US equities were down similar amount, about just under 4%. A stronger US dollar hurt US investors, and EM slightly outperformed developed markets. China remains under the microscope. I think, their economy appears to be slowing. New business in the country, given their COVID policies, has slowed. And obviously, I think most people have seen the real estate headlines and the concerns over the real estate sector in China. Within fixed income, the broad US market, as measured by the US aggregate, is down about 3.2%. We did see a strong first quarter return for core fixed income in the first quarter, slightly negative in the second quarter, and down over 3% in the third. If this continues, this would be a third straight calendar year of negative performance for core fixed income, with hasn't happened in my career. It's been a very long time. We did see, and most of what we've seen this year is investment grade credit has outperformed treasuries, and high yield in particular has outperformed the other sectors within the fixed income market. Turn to page 3 of the flash report, showing the market values. See total assets about 471.7 million at the end of September. Largely the asset allocation is consistent with past quarters. You'll see the underweight to global equity long short, given the termination of Blackstone, a bit remains held there until their audit is completed in 2024. Slight overweight to private equity, but you can see in the net new investment column some of the distributions coming out. So the largest allocation is the 2014 fund, and distribution of 315,000 was made during the month in that fund. Underweight to domestic fixed income and slightly overweight to absolute return.
Bert, is it fair to say that virtually all of our China investments are in the BlackRock emerging markets? Or there's some dribs and drabs that some other funds might have?
ABS could have some exposure there. But yes, I think predominantly it's going to be the emerging markets fund with BlackRock. I think China makes up about 30% of the EM index, and that strategy will
Chester have some?
I doubt it.
At value, no, probably not. There's probably not a lot of like quality value, like typically, right? Like in terms of how they invest, so.
You don't have to add the value of growth on it.
Yeah, and they're
Yeah. Right, quality, fair enough. You know, what you might see though is, sometimes they call, EM facing companies that could be developed markets, whether they're US or European, that sell to Chinese consumer. So when you think of like luxury good, like the largest buyer in the last, 15 years have been Chinese consumers gobbling up Rolex watches or wine or Hermes, things like that, Chanel. Yeah, so those could potentially take a hit, even though they're not technically EM companies.
And
If you had to guess, would you say our total China exposure is under 10 million?
10 million.
To be honest,
Yeah, I think that's a reasonable.
I don't think it's at a meaningful. Like,
Yeah, okay.
in terms of
Yeah,
concern,
but you will
let's put it that
see
way. Yeah.
In Walter Scott's performance, for instance, they hold 2 insurance companies based in Hong Kong. And if you read their conviction in the companies, it has the sell-off has nothing to do with the quality of the companies and the business model. It is China aversion because they're based in Hong Kong. And you'll see in performance, they significantly underperformed, and unfortunately, the result of some of that is playing out.
Is it change of policy that is causing a performance, or actually business level performance is actually low?
I think it's investor sentiment when it comes
Political
to.
concerns.
Total concerns, yeah.
Yeah. So if we turn to the next page for performance, LSV continues to do very well on a relative basis, down for the fiscal year to date, which is July 1st through September 30th, but outperforming their Russell 2000 index. And longer term, they've really done a great job over the last couple of years. If you recall, they trailed for quite a while when growth was significantly in favor, and they've done a nice job. Principal Dynamic Growth has underperformed fiscal year to date. Year to date, they're roughly in line with the benchmark. I think the third quarter, they did underperform largely due to some of their tech names within the information technology sector. And, if you talk to them, their style of secular growth has really been out of favor, especially as we saw value significantly outperform growth in smaller caps and international. You can see Silchester, your developed international value manager, has done a nice job. One of the bright spots in positive territory for the fiscal year to date, ahead of its benchmark. And Walter Scott really had a tough second quarter. If you recall from when we interviewed them, this strategy is a little more concentrated and tends to be low turnover. Their growth process was certainly out of favor, and part of that is utilities, stock selection within that sector, and an overweight and underweight to Japan, which was a bright spot for international equities, and the insurance companies based in Hong Kong that I mentioned earlier. You know, from a talent perspective, we still really like the firm and the strategy. I think it's been a rough entry point for Norwalk so far, but we'll keep a close eye on them and potentially have them in 2024 to present to the board. BlackRock has done a nice job. You can see outperforming for the fiscal year to date and trailing 1-year periods. And then ABS provided some nice protection in a volatile market, down a little bit. But over the trailing year, they've performed in line with expectations. The private equity numbers are lagged, given how close we are to quarter end. In our quarterly report, we'll have updated figures on the private equity. And then within fixed income, we'll get into this more in the next agenda topic. And you can see Prudential, you know, really going to be fairly close to the benchmark. This is index plus strategy is kind of how I would characterize it, but they've done a nice job sticking to their knitting. And then Metropolitan West, the TCW fund, again, has a slightly longer duration position, which they do believe will play out in their favor, but you can see over the last 3 years, it has really hurt their performance. And then finally, PIMCO and UBS continue to be nice diversifiers for the portfolio. See, UBS has done well over all periods, and PIMCO, while it does have some equity within the fund, which really drove some of that performance, longer term, they've performed well.
Is the UBS product open now, or are
I think so.
they, I mean, just looking at their historical returns as we go into a discussion about fixed income, pretty steady 5-6%.
Yeah, no, I mean, they're a good ballast for the portfolio. I know we had been a few months ago, and you know, a lot of their investments are not going to be correlated with the public equity and fixed income markets. And you know, when things go south, that's why they're there in the portfolio.
I mean, how do you guys feel about that product versus fixed income alternatives?
I wouldn't necessarily compare the two. I think the makeup in terms of the characteristics of the underlying components themselves are going to be a bit different. There could be liquidity issues with some of the underlying holdings there for the UBS, and probably more volatile, I would think.
If you look at their history, though, you know, it's just,
yeah.
seems rock solid at 5 or 6%, unless I'm missing
And
something.
they're really trying to hit singles in any market environment. That's
Yeah.
their goal.
They've got more levers to pull than just, you know, like a core bond fund.
Right.
So that helped them.
Okay.
Are they holding different assets also? They're holding like all assets, so they hold equities too as part of their.
Yeah, they'll have exposure through different, you know, use of derivatives and, you know, different vehicles there, so.
Long, short,
Yeah.
event driven, all
Yeah,
sorts of stuff.
broadly.
Yep.
Okay.
Yeah, so
They were the ones that have that matrix of exposures and markets and how they.
Right.
So not the fiscal year, you know, not off to start we were hoping for, but your managers largely are performing in line with expectations. And you know, over the trailing year, you can see returns have been good on an absolute basis, almost 13%, and longer term have been in line with your discount rate.
October was what? Like, what was the S&P in October, do you recall?
That's a good question. I didn't look it up before. I haven't looked at October.
It was down balanced
Yeah, it did come back.
in first part of November. It's
Right.
Yeah, in
balanced.
October it was down. That's for sure.
October's down.
So
now
October
it's
was not great, but
Right.
it's balanced in November.
Yeah, I think largely we expect, given everything going on in the world, the uncertainty,
Yeah.
I think volatility will continue for the foreseeable future.
Okay.
Yeah, this is 3 months basically. This is the first quarter basically, right? Or this is not quite there.
Exactly. July 1st to September 30th.
Yeah.
Yep. And they're preliminary. They don't include private equity. but, yeah, it was another quarter where we saw public equities and fixed income down, and the ballast of the fixed income market has been, it's been tough.
Speaking of which, shall we move on to that?
Kevin's gonna start us off. I think the goal here is, one, let's talk about how the fixed income portfolio is positioned in the pension plan. You know, how fixed income works and reacts to interest rates, and, you know, we can walk through a couple short duration examples. I think one thing that we do think would be good for the board is to have TCW MetWest in the present.
First,
What's that?
now, right, first.
Yeah, I think next month would probably be good to hear from them on what they're seeing, the opportunities they're seeing, why they're positioned how they are, and really better understand their outlook going forward, and why they think that the strategy is right to perform and outperform compared to the last 3 years.
Are they constrained though by what their benchmark is?
To a degree, but the aggregate index is largely treasuries, and ECW is a core plus manager, so about 15 to 20% will be in riskier sectors of the fixed income market. So whether that's more credit, CMOs, ABS, and, you know, over the last 20 years, it has done well, but it has not outperformed of late.
And that would be the this chart, right?
Well, that's the total portfolio, so that includes.
That's a domestic fixed income, right?
Correct, so that's,
Versus Bloomberg aggregate.
yeah, so that's gonna be TCW and Prudential, versus the ag, and then obviously those, different, indexes ETFs that we looked at down below are the two bottom lines, the GovCred 1 to 3 year, and then,
The two short ones.
yeah. And, you know, it only goes back to 1999, so something we have to keep in mind is.
Yeah, I brought the
You brought the extended.
long term,
Yeah.
long term.
Right, because the point being that
Almost see the bottom
this
there.
is like a, you know, rates near zero for the entirety of the chart that we show. So everything looks tight, but
Yeah, this goes back to 82.
I looked at it back to 76.
Yeah.
yeah, right, right. So we'll touch on all of that here in the next couple of minutes. We're kind of starting us off page 2 and 3. Page 2, hopefully this is, everybody knows where we're at currently with the domestic fixed income portfolio. Page 3 is just where Norwalk stands in terms of the allocation versus public fund peer group, and sort of that mid-range, 100 million to $1 billion. The Norwalk's portfolio is underweight most public plans, and that's been, you kind of mentioned it when you walked in earlier, that's been a positive given what's happened in the market environment. You know, whether that was some sort of tactical call or not, let's just say it's been a benefit and kind of leave it at that. I think one thing to keep in mind is that a lot of other plans on public funds have gone more into illiquids, private markets, whether it's, you know, heavier on the private credit, non-core real estate, private equity type of allocations. And so they have maintained higher fixed income allocations as a source of liquidity for benefit payments. Norwalk, because it hasn't gone as far into the privates, has been able to pull liquidity from, you know, other pockets along with fixed income. You know, a lot has come from the equity side because equities had a nice run and they're over target, so we can always use that as a rebalancing tool. So that does factor in a little bit in terms of the comparison here. But that being said, I still think you'd be underweight, most of your peers in this space, particularly over the last 3 to 5 years, right? Not,
And given kind of where we are today, what we've gone through, say most of my large public fund clients are potentially increasing their allocations to fixed income. Given the outlook, I think this year, capital market 10-year projection was 4.5%, and that's expected to go up when we publish them again in January.
and go up by 100 basis points, which is significant.
Yeah, we don't usually make those kind of changes to
Yeah.
our 10-year outlook. And, you know, when you think about the conversations we've had in this room, how can you earn 6% in a vehicle that's not as volatile as equity? And I think the outlook with fixed income is you're gonna get more of that than you are anywhere else.
And I think we have to keep reminding ourselves how extraordinary the increase in Fed funds rates in 22 was just off the charts.
Yes.
And,
And as bonds roll off in these portfolios, you're gonna take the price hit, but the forward-looking yield is gonna be significantly higher.
Maybe we haven't really been in an environment where you could do a whole heck of a lot with your fixed income portfolio for, you know, look how far back you had to run that chart, right? To get to a rate environment where, and we're finally actually starting to now creep back into where we can get more creative and draw more yield without having to take on any more risk, which is really, you know, ideal, particularly for public plans who have benefit payments on a monthly basis.
Part of it is too, the discount.
Right.
Factor down
Yep.
to a more realistic level.
Right.
So it's a lot easier to make to make the hurdle.
Yeah.
And the city's taken the pain to do that, and I would say you're on the lowest discount rate of any public plan I work with, which I think is
Wow.
great.
Yeah.
I mean, a lot of state plans simply don't have the ability, when you think about the billions of dollars
Right, right.
that small change will cause. But, you know, we commend you for that.
how much of the Bloomberg index return is attributable to yield versus capital gain?
Yeah, if you go to page 6, below what we'll call Rich's chart, is the chart we put in that shows the breakdown between the yield or the income versus the price return.
Yeah, okay, I got it.
And you can see that overwhelmingly, it's more about the income that's being collected from that yield. And I think that's one thing that maybe has gotten lost a little bit in some of our prior meeting conversations is it feeds into, price return obviously feeds into the total return, but it's not always so much just about that. You know, to Britt's point, when you have an active manager who's rolling and trading in the market day in and day out on your portfolio, and being able to now in this type of environment reinvest those proceeds at any point in time or trade into a higher yield that might be available is powerful. I also think that, you know, there's just chart, and this is something that you all just talked about. We were all the way, you know, the column to the left-hand side, if not worse, over the last, you know, 18, 24 months. So we just experienced all of that, you know, historical to a certain extent, you going back to like the 70s in terms of that sort of an increase in that short amount of time. All of the right is the opportunity set, let's call it. David, you mentioned earlier that you saw rates come down a little bit, right, already in the last couple of weeks. So, I mean, you can see what happens when rates come in 50 basis points, right? And I think the point is that we're not in the business of you know, making calls on interest rates in terms of which direction they're going to go or by how much. But here we almost don't need to, because all of the opportunity set is arguably ahead of us, regardless of what happens to rates to some extent, right? Assuming they don't drastically fall or drastically rise any further, which if I had to be a better, that's one thing I would bet on not happening.
But aren't we talking about we're not talking about. Our duration is only is
6 years.
a 6 year.
Right.
And so we really need to, in my opinion, the focus is on the 5 year, really the 5 year and 2 year, and the 2 year. Cause we're not in the area of, we're not talking about extending duration.
Well, we're not. Your active managers, depending on what happens in the environment, they could extend that duration, but
But they can't extend it for 3 years, can they?
I think so.
I think there are constraints,
The
correct.
the benchmark is right around 7 years, isn't it?
It's lower. I think it's six.
Just over 6.
Yeah,
And I think TCW is about a year.
yeah,
About a
they're
year.
around 7.
Okay, and so, so we're not talking about the opportunity set that exists in the 10 year treasury out to the 30 year.
Correct.
And so, when I look at the plus or minus 50 basis point rise, I see on, the 5 year, the difference between the 5 year and the 2 year, what you're giving up is roughly 100 basis points. On the, if they fall 50 basis points, but you pick up, not quite, a little bit more than 150 basis points on
On a short term.
on a short term rise. So it's, to me, that's the thing to focus on is the change in the change in that plus or minus 50 basis points or plus or minus 150 basis points.
I would agree with you if this were a personal account or even something more, I don't know, short-term oriented, but not necessarily for a plan that is designed closer to perpetuity, right? I
Well,
mean,
not really. This thing's gonna die
It's gonna die, but
in 50 years, which is a lot less than perpetuity.
correct,
Or,
but my
it's
my
like
point
30
being,
years.
50 years is a long time out. We're not worried about, I mean, 50 basis point rise or fall. We're talking about making a call on the next. I mean, even if we say the next 2 years, that's nothing in the grand scheme of what this plan is designed for. So that's very, I would argue that's too short-term oriented for a plan of this nature. Because what you have to keep in mind is you're making, we've talked about this in the past, but you're making tactical judgment calls on both ends,
Oh, I understand that.
right? When to get in and when to get out. And I mean, you could argue we've already, left some on the table, that's not the business of Callan, and I would argue it's not the business of the board either.
I don't disagree with you at all.
So all of our assumptions are 10 years out.
Yeah, but you're gonna raise your 10 year assumption by 100 basis points, so. I mean,
Yeah. We are, all right. And so, the 2% that we recommended to add to fixed income last year is gonna go up if we were to run it again in the
Right.
spring. But it's gonna be about, adding to the ag, not the short end of the curve.
Yeah, I think the other difficult thing is that we're looking at this as a snapshot in time where we're coming off the worst calendar year for the US aggregate index. We saw rates go up 5%. In our projections, we had that happening over 10 years, and it happened in 1 calendar year. So in the short term, it will take time for the total return of these funds to come in line with the new yields that the market is having. And, from a starting yield standpoint, whether rates rise or fall, they will yield significantly more than they did 2 years ago. And you know, we have a lot of charts in here to try and look at different time periods. But, you know, picking where we are today and looking back, if you had owned short duration at the start of last year, you would have done very well. Making that call today, I think, is much more difficult. We've already experienced the pain. We've already realized the losses that we've seen over the last 3 years.
Yeah, it kind of feels like, I mean, you know, 3 years looks rough, but it's also sort of cherry picking, you know, everybody always says you can move the needle on the time frame you look at to, you know, support your argument. But 3 years feels very short-term oriented. As Britt mentioned, one of the worst 3 years in the entire history of the fixed income market. You know, if we looked at equities in 2011 or whatever it was, would we be sitting here saying, man, we should jump ship at equities and right? But then we would have missed, you know, one of the most historic run-ups in the, right?
None of us are that smart.
So it's, you know, there's,
It's by the retro markets.
right. We have no idea what's gonna happen, but history, you know, does give us some guidance. Things do tend to repeat and, I think it's to Britt's point, we've lived through all the pain. It would be, we're very hesitant to all of a sudden now, you know, exit stage left and.
Well, we're not talking about exiting stage left. We're talking about,
Right,
do we, I think, do we go with a third, you know, to shorten the duration out to 5 years? That's not exiting stage left.
Yeah.
And also, when you look at the 2-year line, you have, you know, 50 basis point rise, 4.6% return, 150 basis point rise, 3.7, a 300 basis point rise, 2.3. You know, those are all respectable numbers. And then on a fall, it's 5.5, 6.5, and 8. So it's not as if
Not getting anything.
we're not, you know, getting anything, and I would imagine, and you know, we're taking, and I see us taking some risk out of the book, given the level of uncertainty.
so you're talking about, you mentioned getting, what'd you say, 2.3%, and that would be
A rise.
Looking at the 2-year.
the 2-year rise.
2.3% on a 300 basis point rise versus a 5.5% decline. Will be at least a 5-year treasury duration around 5 years. We're a little longer. It would, that, you know, that's a 800 basis point swing in performance. That's an extreme. When we go into 150 basis points, it's over 4%
Yeah, no,
shift in performance.
you're willing to take less on the upside for protection if rates rise.
Especially when you know, I think we're still at an inflection point where there's more uncertainty now than than typical.
I guess I just want to make sure I'm following your line of thought. So what you're saying is you feel more comfortable and would willing to get that 2.3% return? Is that what I'm hearing, as opposed to where we are now with the potential risk in the portfolio? I guess I think about it in the longer term, like, I mean, you have to.
Well, you know, I'm not saying that, you know, this is over estimated 12-month return, but over it could be a 3-year period or 4-year period.
Right.
Numbers aren't going to be that dissimilar. And so it's not, I'm not just looking at the next, you know, 6 months. What if we have a 5-year period of this level of uncertainty in the global market as we figure out how the world responds to 5.5% rate versus 1%, 150 basis point rates.
Yeah, no, I think that's what I thought you were saying, because that gets to me, I mean, if we're in this environment for, like, I look back on page 4 and I look at, I mean, this is extreme, but I look at the far right column, which is, this says the last 31 and a half years, right? And in the current portfolio that Norwalk has, I mean, it's 4.65% is the return. So to your point, like, if we were to have the next 31 and a half years of this kind of chaos and we were just picking up 2.3% annualized return, like, it's still half of what Norwalk's portfolio has done. Right? Like, you understand that?
Well, yeah,
But it's being disciplined enough to actually pick that up over time.
The half was, you know, you're talking about this period where you also had price appreciation working for you. I'm looking at more of a period where you're not going to have, you're going to have a higher yield. And so that's going to help your total return. But what I'm looking at is how much price risk do we have to take to get that total return?
In the short term.
In short term, to me, can be is in the next 3 to 5 years. And, you know, certainly I can't go, you know, really beyond that. I'm just trying to see if there is a reasonable way, in the same way that we have a certain amount of growth, we have a certain amount of value in the equity book, is that, you know, right now, we have all our debt in a single duration in bonds. That's right around 6 or 7 years.
Right.
What all I'm saying is it prudent to shorten some of that duration, given, yeah, I'm not making a market call, I'm not, you know, you're doing anything, but right now, we don't have any diversification in our price exposure in the fixed income.
Right.
Well, those duration numbers are weighted average for the whole portfolio, right? So there's a chunk of 2, a chunk of 5, a chunk of 7, a chunk of 10, presumably, right?
That's right.
Yeah, you can see it on.
But it
18 and 21 for each portfolio. I mean, they both portfolios on bonds with longer durations than 10 years and both on shorter duration
right.
bonds.
I guess, you know, I think it's a fair point in terms of diversifying. What I would maybe add or think about is, right now, the overwhelming, and you can probably speak to this better than anybody, the overwhelming risk in the portfolio is equity risk, given the level of our equity exposure, right? And so, and we're low on the fixed income side. I mean, is there a place that says maybe we diversify within the fixed income, but we actually increase the fixed income allocation itself?
But what I was bringing up in the equities is that we decide how much money we're gonna put in equities.
Right.
We're willing to accept all that price risk. However, we diversify between different classes of equity and different return profiles in equity to diversify our exposure against that.
Yeah, right.
You know,
I get what you're
whether it's-
saying.
Whether it's small cap or mid cap or value or growth or developed or emerging markets or.
Yeah,
But what my concern is that we don't have any diversification in our fixed income risk.
Yeah, the issue with the, the equity side is when the equity market goes down, that's all gonna go down. It's gonna go down at different levels. Value might go down less than.
Oh, yeah, I understand that.
Right, right.
And
With
that's
fixed
what-
income, there'll be some offset actually, like on the short end, we've seen that, right? And
So
so,
I'm not, I mean, that's what an average, an average or effective duration calculation is all about.
right,
Is so that it balances all that,
right,
all that.
right.
all
I mean,
that
it's
good
extreme
stuff
right
out.
now in terms of the whole yield curve inversion and right? That's playing out. I mean, it's starting to rein in a little bit in the last few weeks, but,
That's what here's, in your other public pension plans, what's the spread of duration, duration in your different plans? And do they all have the same exact profile? There's no spread in it. I'd be,
they're spread from a risk perspective, but not
Yeah.
necessarily from a duration
well, I'm
perspective.
not spread, I'm talking about spread in terms of duration. Is there,
How do you find that?
well, for example, is everybody at 7 years? Or,
Yeah, that's
or
the
we have
average.
people if.
No,
or
no,
do we have
and we have a
people-
chart, so just,
People at 5 years, or do we have people at,
well, I think we
they're all
need
out at
to-
10 years?
I
You're
think we
saying
need to,
mix in a
Page 18,
fund
is
that targets 3 years or 5 years or something.
No, what I'm, yes, what
Because
I'm.
these guys are all investing in different tranches, different durations.
I'd say overwhelmingly, client portfolios, domestic fixed income portfolios in particular, are benchmarked to the equity. Overwhelmingly. I would say I have one client that is benchmarked to the Bloomberg Universal,
Mhm.
and they implement their fixed income portfolio through opportunistic and heavy credit managers. And things like emerging market debt, which are much riskier.
Oh, yeah,
We do have clients that have a short duration component of their fixed income portfolios. It tends to be a liquidity bucket.
right,
So if they need a source of, if you're 50% funded, equity markets are down 20%,
Mhm.
bond markets are down. Where am I gonna go? And they tend to have a liquidity bucket within short duration.
Does that help, would that help us?
Well,
Given our liquidity needs over the next few years?
I don't think it will change anything, because the total plan is extremely liquid. I mean, you have a small allocation to private equity, small.
No,
allocation to
what I'm talking about is that if let's say the, rates rise another. The easiest way to do this is 150 basis points. Where
well, that,
at our 7 years, we'd have a 60 basis point hit. Whereas if we were in a blend of 7 and 2 years, we would probably have a bit of price appreciation, so we wouldn't be selling that selling that at the lows.
Brit's point, I think, is more that they're not using that as, that's a very like strategic decision that we can't put these dollars at risk because we need.
Oh, I
everything.
understand
This,
that,
but I think
but
our discussion is more of a,
I
Right.
thought that was I thought the point was very, very valid and it's given what our liquidity needs over the next number of years. If the equity market is going sideways, the bond market's working sideways to higher, having some shorter duration fixed income might be a good place to park money to
Hey, Ben.
be able to take it, to be able to fund our, we're in a negative draw as the fund is now. We know we're gonna.
yeah. Should we be should we be increasing the fixed income allocation for that same rationale?
No. I'm just trying to move some of the fixed, I'm just trying to get us to think about whether we should lower the risk profile of our fixed income portfolio.
Mhm. And yeah, and if ultimately that is. If the board feels that there is too much risk on the table, given the interest rate environment and the outlook, and shorting that duration in a very liquid fund gives you conviction and being able to pay benefit payments, not have to tap equity markets.
Or even tap on
No.
longer duration.
I don't think we have any issue with that. I think our only argument would be, we don't think the plan needs a liquidity position to support your current profit.
Let me help me understand something here. So both of these funds are investing in multiple duration securities. So we already have investments in 2-year.
But their average duration, 7 years, that's the number.
Well, you're saying if they had to raise money, they would have to sell out of their whole.
They're slightly
portfolio,
different.
and is that what it's?
No, what we would be selling a 7-year duration product.
Right.
The,
So you're saying if we need to tap money out of, this is only an issue if we need it for liquidity, correct?
It's,
Because if you're gonna stick with it for 5 years. It won't matter, will it?
what won't matter.
The fact that they have 2 years duration money here,
Right,
but if you don't have to sell it over the long term.
well, they take a slice across the portfolio. They don't just say we're gonna sell these
No,
particular.
I'm just saying, if we don't have to sell this down.
If we could raise it elsewhere, you're saying?
Yeah.
Yeah, I mean,
Does that negate this issue?
what happens is when you think about rebalancing, like we've got targets, right, for the allocations and ideally what you wanna do is rebalance the portfolio as a whole, to keep those, every allocation close. Otherwise, then you're kind of making tactical decisions about where to draw from at any point in time, which we don't love. I mean, you can do it, but, if you're in an equity drawdown, maybe you take a pause on pulling out dollars from the bottom. But you'd like to rebalance holistically across the portfolio as much.
But we're already below our target on fixed income, so.
We're already below, correct.
So it's unlikely we would take it there first.
Right, but I think Rich's point is like, if we see a big, downward move in the equity market. Is that fair? Like, you don't wanna necessarily have to pull out of the equity, you'd rather use the fixed income as a.
we don't want to sell them the whole.
Right.
Okay.
One thing to keep in mind is that you've got slightly different duration profiles between the two managers. TCW is frankly the one that's hurt the portfolio more because they're taking a longer duration bet. They're the one that they're like 7 and a little over 7.25. Pru is more close to the ag. And that makes sense, because that's on page 2.
What's the duration on the aggregate?
6.3.
6.3.
Pru's right in line, therefore on TCW.
So Prudential is gonna be right in line with,
Yeah.
I would call them an actively managed index fund. Net of fees, you're gonna get pretty close to the.
7.13 versus 6.32. It is,
But you're getting more yield out of a manager like Pru because they don't have to, they're not constrained by simply investing in the ag. They can invest in more credit. I mean, that's always been, the ag's been somewhat of a low bar to beat over time.
is your point also this, back to the chart on page 6, and there was a make this chart right here, right? And the question is where we want to be in that chart in terms of position. And over the next 5 years.
Right,
Right.
and right now, we're in one spot.
Right now, we're right on here,
Right below the 5-year.
right in the area right now. And the question is, would it benefit us to be here? Or should we be up here? Or should we stay where we are?
To move closer, move the duration down from 7 years to, let's say, 5 years.
So regardless of whether we sell or don't sell, doesn't matter. It's almost like, where do we want to be in the next 5 years, basically?
Right.
It just, so so what risk we want to take on and what's gonna be our reward that we're expecting.
Right. And to Rich's point, if you want to bring that duration down,
This is what I'm doing it.
the risk is gonna be brought down.
Yeah.
And the downside is gonna be brought down.
And the upside
is-
also goes down a little bit too.
Mhm.
The upside
That's right.
goes down a little bit
Yeah.
too.
And I mean, from my personal belief and, you know, what I've talked to clients about and who have similar pieces of their fixed income portfolios. If that diversifying that duration risk and having, you know, that short-term fund there if you need it is perfectly acceptable. There's,
Yeah,
I think from a long-term standpoint, completely abandoning the aggregate as the long-term goal, I think we would probably disagree.
I do disagree too.
Yeah.
I don't think we should.
But having you know, a shorter duration piece as a component of the overall portfolio, I personally am totally fine with that. If that's
So if rates continue to rise, it would benefit us.
correct.
If they fall, it would hurt us a bit.
Exactly.
So it gets down to what we think is gonna happen with rates.
for the next 5
Well,
years.
no,
Yes,
But I would,
No, it
I would
doesn't.
think of it, I would think of it,
that's not the argument. That's not the argument I'm basing it on. I'm basing it on an argument about taking. Can we lower the risk profile of our fixed income investment without sacrificing too much performance in return? That is the, and it has nothing to do with what I think rates are or are not going to do.
You could manage around rates, managers can manage around it. It's the magnitude of the, you know, in terms of the speed of the rate change that has been the killer.
Yep.
You know, if rates are on a steady incline or decline, they can handle that. It's just that they went up, you know, exponentially in just a short period of time that
Yep.
people got, excuse my French, caught with their pants down, right? So,
Mhm.
that's the issue is
Biggest percentage change in history, I think.
right for such, right, over 12 or 18-month period, whatever, it is. Yeah.
but yeah, I think that's.
Yeah.
The way you should think about it is over 25 years, there's gonna be an opportunity cost adding a short duration component to the fixed income portfolio. And as long as the board is comfortable with limiting that potential upside and making, you know, being able to utilize that bucket if need be to pay benefit payments or whatever outflows may be.
Should our, you think that's a very different time frame than 5 years, right? Should we be thinking 5 years, 25 years when you make this decision or think about this decision? Or what kind of horizon should we be thinking about when we look at this?
There's two different components and then maybe Rich can jump, but you wanna jump in first and then.
No.
I was gonna
I remember the point I'm going.
Okay, I was gonna say, to me, there's two different components. There's the structure component, which is just the fixed income portfolio, fixed income allocation. And those typically have a shorter period of time in terms of the thought process there. And then there's the asset allocation itself, which we're using 10-year assumptions. So we're looking at least a 10-year period, because that's what we're baking into how we're setting up everything from the strategic level. I can appreciate the desire to diversify the risk in the fixed income portfolio. I actually think that there's an opportunity though to increase the fixed income allocation to the benefit of the plan. Because you'll pick up based on what's happened with yield, or rates rather, that extra yield without any added risk to the portfolio. And if anything, it'll actually decrease the overall risk of the portfolio because you'll be, I would think, drawing away from equity and you know, reallocating to fixed income. And so now you change the risk profile of the entire plan, you know, as a positive. So there's like in my mind, there's these two things going on, which have different timeframes.
Mm-hmm.
But to Rich's point, I mean, from a calendar perspective, If we could time markets, we probably wouldn't be sitting in this room.
I'm not saying, you know, we don't have the United States in 6 months.
Right.
That's
And
a-
we have no idea what's gonna happen.
Yeah, of
Yeah.
course.
Hey, but-
And
Go ahead,
No,
finish your point,
please,
then I'll make my
please,
point.
I was just, we think long-term.
Mhm.
And when you're not here at this boardroom and another group is sitting here trying to understand. As long as everyone understands why it's here and what it's here for. And understanding the upsides and the downsides of an allocation like that is what's most important.
Mhm.
The argument that was made about giving up opportunity is a valid one. But we're giving up opportunity already when we make our diversification decisions in fixed income. I mean, in equity markets.
Right.
We don't, the highest potential return is in, I don't know, small cap growth.
Right.
But we're not 100% invested in small cap growth.
Mhm.
We're giving up opportunity because it's too risky to be in that.
Right,
And so. This, yes, I agree that there are, with the higher rate environment. It is more opportunity to earn yield and help and meet our bogey and all that kind of stuff. But it doesn't come without risk. And in the past, I don't know how many, when we look from 2013 to the current, it really wouldn't have made much of any difference whether you were diversified across the yield curve or not. In your duration bucket. Now it does.
right.
And now that it does, I think it's appropriate that we take a look at it.
Yeah, and just to clarify, my comment on opportunity set was more about using today as a starting point.
You know what I mean? So.
I
agree entirely.
Yeah.
And where it didn't make that much difference. From 2013 through certainly 2021.
Right.
Whether you're diversified across duration. Now it does, given the steepness of the yield curve that we have.
Yeah, and the big killer was arguably last year in terms of the correlation between fixed income and equity
Oh, yeah.
markets.
I mean,
So
that's
I think people would feel a lot better if fixed income had provided like what you think of in the classic sense of that downside, right, that
Mhm.
buffer, and it didn't happen, unfortunately. Everything
Yeah.
broke the mold last year.
Yeah, I mean, the Bloomberg aggregates only. It looks like it's only had a negative return, like literally a couple of years in the last 50.
Right,
yeah.
It's incredible.
yeah,
And 2022. Is that 2013? 1999, it touched zero, yeah, but it's. Yeah, it was a weird year. So does this all say though, so make sure I understand what you're saying, Rich. So if we had, let's pick some round numbers here. Let's say we had $100 million of fixed income investment. And right now we've got 100 million with an average duration of 7 years.
Right.
If we switch that to, and that 100 million has a bunch of, 2-year bonds in it and 5 and so on, right? But it averages out to 7.
Right.
Okay, so let's say instead of that, we had,
Well, on page 14
yeah,
is an example of.
Yeah, to your point, Rich, if it was. If risk control is ultimately the goal.
Well. Return.
Well,
Yeah.
yes, but in terms of your fixed income allocation. We would want to take a closer look at your 2 current managers to understand, okay, Prudential is going to be pretty straight and narrow, close to the benchmark. TCW is going to take bets and they're going to have much higher allocations to out of benchmark securities. Finding whether both of those are warranted, one, and two, what is the right duration level that the board is willing to tolerate in terms of shortening it? To your point earlier, a third would get you close to 5 currently. If you wanted to overweight or underweight one of those active managers, that's another decision. And maybe what would be helpful is next month to come back with some a deeper dive into the risk of the fixed income portfolio to try and understand what a hypothetical portfolio could look like, and the trade-offs between the two.
Does that answer sort of your question in terms of like, what would it actually do to the duration of the overall portfolio?
Yeah, well,
Probably doesn't bring it down as much as you
I'm
thought.
just trying to think through the math of how this works. If you've got one fund invested at 7 duration versus having 2, where one's at 10 and the other's at 2, and it average out to 7. Does that make any difference?
No,
I didn't think so. That's what I'm trying to get my head around.
Well,
It matters, I guess, if you have to sell.
you'll have a smoother. There'll be a smoothing effect because of that lower duration portfolio as opposed to the one that's.
Right, one's gonna hop around, the other's gonna be more stable. They're gonna average
Yeah.
out to about the same thing. I guess there's one fund with 7 duration.
Right,
Right.
which is why I think we're like,
Not
exactly.
Not exactly,
right,
Okay,
not
right.
exactly.
but close.
I've seen when it's not.
Okay, all right. I'm just trying to understand the math, but yeah.
Particularly if the curve inverts. It doesn't invert all that often, but
Mhm.
if it inverts, you're gonna get smoked on the longer.
Yeah.
Duration stuff.
I mean, we can run
No.
analysis. Yeah, no, and then if we get to that point in terms of like, we wanna look at actually structuring a
Yeah.
portfolio, if we've got 2 or 3 managers that we, wanna go with and how that will look to the overall profile, but,
But these two that you.
Sorry to belabor this, but I did this for
right.
15, 20 years as a profession, so.
No, totally get it.
But this BlackRock fund. Yeah.
Yeah, so we didn't do a search.
Mhm.
But working with our research team, we identified the major passive providers, reached out to understand, what funds are available off the shelf that are easily available in terms of short duration funds, and State Street had one, but not the other. One thing, we have both just short government funds and short government credit funds, which are a little more diversified, still, very conservative index. BlackRock and Vanguard kind of came to the top in terms of have funded vehicles. You can see, BlackRock's Gov Credit Fund, only 270 million in assets. But both readily available, and fees seem reasonable. BlackRock's more competitive, but it's not an off-the-shelf mutual fund like Vanguard.
So talk me through a little bit, I'm just looking at the BlackRock government credit fund. So its yield to maturity is 4.4%. And then if you look at the, kind of current returns, they're much, on a year-to-date basis, much lower. Is that just,
Well, yield to maturity is if you held every bond in
Yeah.
the portfolio to maturity.
Right, right.
So that's that price, versus the
Right.
income component. The income is really what's driving,
Yeah.
if you hold everything, it's a much larger piece of the
Yeah,
portfolio.
the returns got whacked by the price
Right.
going against them this year.
Still,
And you'll never get the yield maturity because you have a constant turnover of 2-year stuff that you have to take the losses on.
yeah, and, right.
When you never get the yield, which I didn't understand that.
No, I'm saying the
Most-
yield
these
maturity is
managers
over
Are
5.
not gonna hold.
No fund gets that.
They're,
because
they're being
constantly-
actively,
yeah,
they're
They're
not,
constantly maturing and they have to, replace them.
yeah, they're not just
So they're
buying
taking
and holding
some
bonds. I guess
Price
it's-
losses
It's idea
as they turn over their portfolio, right?
Well, it's
Yeah.
a pretty educated estimate on what the yield to maturity of the, right, like. It's not that you'll never get it, it's just that there could be a heck of a lot of volatility in the interim, because they are still actively trading.
Yeah.
Components underlying.
Okay. So we'll hear from, which one next month?
We would suggest having TCW in. If anything,
They're the riskier one.
they are, and their performance has struggled. And, I think
Mhm.
understanding why they are positioned the way they are and what their outlook is, I think will be beneficial to the board.
Okay. All right,
And it's how they make their duration exposure.
Yeah.
How much wiggle room they have, how much they can go, over and under, how do they decide it?
Yeah,
Yeah, no, I think, what we've seen over, and Kevin and I have talked about this, but duration bets are very difficult. And we've seen a lot of fixed income managers in this environment get hurt making duration bets. And it's the reason a lot of these managers try not to make them. Is there anything else specifically that you'd like to have them cover other than, understanding their process or structuring the portfolio, duration, positioning, outlook?
How much credit can they have?
I say it's about 30%
sounds right.
across,
Yeah,
across all plus sectors, and not just investment grade. Talking ABS, CMBS, bank loans. It's usually around 25 to 30%.
Thanks,
good.
sorry for.
No, it's good. We good stuff.
That was good, yeah, that was good, it's helpful
Yeah.
to understand your perspective,
We
absolutely,
lived this for a while. It's good to have what you have to say.
definitely.
we know where Frank stands, so it's good to hear from everybody else too.
Definitely.
Frank wants to hire a bond trader.
Yeah.
Okay. Enough on that, I guess, so, the meeting schedule, you guys sent around?
Yeah.
Same old, right? No changes?
Maybe this is more of a question from me, not something I remember, but. The asset allocation study that was presented back in the spring that we all agreed to hit pause on. Is that something that the board would like to rerun at some point next year?
Because Blackstone was terminated, so there's gonna be a
Yeah.
4% underweight to target in that asset class.
Oh, that's
And it's
right.
been an interesting year, so maybe it'd be a good
And I
idea.
think, if nothing else, that allocation's never coming back, and where should that be redistributed?
Yeah.
Right,
And it could be, incrementally to public equities and fixed income, or increasing absolute return, or there's many avenues. It's only 4%, so it's not, and it's already gone. It's already been spent on benefit payments, but.
and part of it is because I do think it ties into this conversation. Just knowing on what the outcome of that study was, which was, it was somewhat de minimis, but it was like 2% increase to fixed income. And I know there was hesitation there, given where we've been at, but and now with the assumption growing stronger. Now, that being said, I think there actually will be a slight increase in the equity, but on a relative basis, the fixed income will override that, so. You know, I can see where things would potentially go, and it's tied to this, so I'm just wondering if it makes sense to. Go through that exercise again and try to find a landing spot for that more strategic longer term.
I mean, it. Relative, it's my sense that relative to a lot of other public funds, we don't get involved in alternatives all that much. And just to update that I think would make a lot of sense.
You put UBS absolute return as an alternative, right?
And the PIMCO all asset as an alternative.
PIMCO assets,
Not really, no.
it's a mutual fund, so. ABS and UBS are both hedge fund managers. So I think the discussion really is around the investment policy and confirming the board's risk tolerance, given that Blackstone was terminated and. You know, seeing. And it's gonna be incremental, but, you know, in the target asset allocation, that 4% needs to go somewhere. And we can revisit it early next year and. See where the board's tolerance is and.
Do we get a performance, you're doing these quarterly performance, do we get one from UBS on their product?
So UBS is a difficult one. They ask for all of your cell phone numbers. I said, I don't think so.
Yeah. Well, how about?
They do usually have a quarterly kind of mailer update research piece, so I can try to find that.
It'll be more like an attribution piece, which will be, it could be tricky first time out to kind of.
Or
Appreciate,
if,
but, right,
you
you know what I'm talking about.
Yeah,
if you guys have, their track record since we invested.
yeah, it's in our,
Quarter.
it's in our
Okay, yeah.
our quarterly report. We will have to you with our executive summary in a week or two, and that'll have all the detail. on it.
Yeah.
But we might wanna, to the point I think you were making. We could explore other diversifiers within the portfolio that don't have to be private market, right? Maybe there's some other areas where we can step away from the equity risk.
I mean, for example, we have little or no REIT, we have,
Yeah,
or that sort of exposure.
Yeah,
REITs
Well,
are tough because they're so correlated to equities. That's the
Right.
only
But-
problem,
But
right?
private real estate, they're open-ended funds that. I think that the issue right now is most of these funds have gated investors trying to rebalance their portfolios, and the outlook with office remains bleak.
Yeah,
But it's an income these are really, income's a big piece of these funds, and, most of the private ones, high quality assets that generate significant income. The issue is there's been so little transactions in terms of a lot of the sectors within real estate that,
Could be real estate, could be infrastructure.
yeah.
pretend and extend.
I think there used to be infrastructure in this portfolio, until about 3 or 4 years ago.
And the quarry and the turnpikes and
I
stuff.
think Franco over my toll road and
Oh, is that right?
somewhere in the
Gosh.
Midwest. So I think there is some scar tissue on some of those, but
Yeah. All right,
predates are.
we good? Anything
We're
else
good.
for tonight?
Good,
All right, motion to adjourn,
seconded,
all in favor? All right,
Right.
all right.
Thank you, guys.
Thank you.
Well done, Mr. Chair.